you hear me
Hold on, let me mute you.
Haven't been muted this whole time?
I just went live. What's up? What's up, guys? We will be getting going in just a few minutes, guys. Just a few minutes. Just wrapping some things up, setting up my levels. If you can hear me okay, just let me know. We'll do a quick sound check. Just let me know how the audio sounds. Audio is really the only last thing I need to check before I get going. Once I get an okay from the chat, we'll rock this out. Waiting for a couple of notifications to go out, but then we'll get going, guys. Thank you, Mark. Thank you. We'll get going in just a second, guys. What's going on, Mark? How we doing, Thomas? How we doing, bud? Thanks for that feedback, Tom. Is this any better, Thomas Winter? Is this any better? Try to lower it a little bit on my end. Let me know if that sounds a little bit better. Thank you, Anton. I'm not sure what you mean by that. If $20 to $40 is 1 to 2% of a 2,000 account, then show the next steps to fall within what rule? What rule are we talking about? What rule? Hey, what's up, Robin? Jake, what's up, buddy? Jake, you gotta be like your cousin, and he always leaves the comment, 10 out of 10, we'll live stream again. 10 out of 10, we'll physics again. What's up, Colorado? A little jealous. I heard smoky out there in Colorado. Hopefully the air quality's good out by you. All right, guys, I say we just dive into this. No sense in waiting around. Too low audio. Too low now. Too low now. Let's see how we're doing there. How are we doing on audio now, guys? Welcome. Thanks so much for being here. Thursday night. First Thursday I've done. Like I mentioned, I will go live every time I get a voicemail. So once I get two voicemails, 1 or 2 voicemails, I will, 10 out of 10. I recommend this page to others. Facts. So, yeah, if you have voicemails, I think we got a voicemail from Jake coming in tonight, and then I got another one. So I'm like, boom, there's 2. Let's do some living. Let's figure this out. And then what I'll do is I'll probably end up putting both of these awesome questions over on the main channel as well. So we got 2 voicemails tonight. I'll kind of do the first voicemail, then I'll take some questions from the chat. I am going to kind of focus on the voicemail just so I can clip it out and make it look good. Obviously, if there's a question, what is the rule? Well, that is the rule, but what falls within that? Oh, the rule is to trade options with 1 to 2% of your account. Is that the rule you're talking about? You lost me, bud. I'm sorry. You lost me. I mean, I'm drinking, but you lost me. All right. So, all right, there we go. Okay. So the first voicemail is going to come in from Jake. You guys should be able to hear it. And then once we run through the voicemail, we'll have his audio should play through the live stream, and then we'll go from there, guys. So let me just rewind this. All right, so here comes a question from Jake.
Hey, Brad. My name is Jake. I'm 22 years old and have a great chunk of change sitting in my bank account right now. I most recently put a huge percentage into the Webull platform so I can invest into some safe index funds, just so that my money isn't losing value due to inflation. Is there any recommendations onto which funds to invest into? Thank you.
All right, so hopefully you guys got that audio. Great question, and a question that comes up a ton, Jake, if you haven't listened to the Average Money podcast with me and JJ Buckner. We've talked about, the difference between saving and investing, and it seems like you kind of made up like your choice that you want to start deploying some of that cash and start investing it. And the question being like what to invest it in. I'm going to touch upon like a few different things. Like when should you send that money into investments? When should you hold it in liquid cash? I know at 22 years old, that fear of I'm losing money to inflation, right? You have to understand, yes, if you hold cash, you are losing money to inflation, but the amount of money that would need to be invested inside cash to lose a monumental amount over time, like you're not going to lose to inflation over 3 to 5 years. I mean, yes, fractions of a cent, So I wouldn't worry too much. Like if you don't want to keep money in the bank because you want to invest it, that's one thing. But I don't see the real need to deploy cash in the fear of losing it to inflation, because having liquid cash on you will benefit you in the long run, and it will probably benefit you before you really see the main effects of losing that to inflation. So there's many different reasons why people store up cash. Number one, people store cash because they want to be liquid cash, right? They're either intimidated by investing, they don't want to invest, they never heard about investing, they think it's like risky, it's gambling, so they just hold a lot of cash. Okay, that's fine. Those people, it's probably going to be tough to talk them into doing any sort of investing. The next type of person is somebody that, has a saving up for a house or a real estate investment or a wedding ring or a wedding and things like that. And they're like, well, I know that the markets are doing good. I know that I'm losing money to inflation. I'm not really getting much interest if I hold liquid cash. I want to deploy some of that. That's the second type of person. And I think the third type is just somebody that has like 3 to 6 months of their emergency fund because somebody told them that you need to be liquid cash, and they just have this arbitrary number of cash sitting around and they don't really know why. There's really no purpose to it. So the first person, okay, like I said, I'm probably not going to talk you into investing. As far as like house, future, like big expenses, weddings, wedding rings, and things like that, I generally have no problem whatsoever investing that money if you are going to be investing that money and that major purchase you feel is more than 5 years away, because we are one day away from a possible correction in the market, right? We are literally one day away. So if you were planning on buying a house in like the next 2 years, you might take a correction tomorrow that might not recoup in 2 years. 5 years, I'm going to be optimistic and say probably. So if you're 22 and you're not planning on getting married and buying a house until you're 28, and you want to deploy some of that money into the market and invest it for a better interest rate or to avoid inflation, I'm for that. But if it's before 5 years, I'm really going to say, like, just hold it in cash and trust me there, because cash opportunities also come up. Hard money lending, buying real estate, things like that. There's no bad thing. Like no one's ever going to, well, I can't say no one's ever going to say. Most people that know what they're talking about are never going to criticize you like, look at that Jake guy. He's got all that freaking cash sitting around. Like that sounds ridiculous, right? Especially at 22 years of age. People should be saying, look at this guy spending money like an asshole, YOLOing money and partying and buying things he doesn't need, right? That's the bigger problem. The last type of person is the person that has this 3 to 6 months and they just feel like it's too much. Like they're like, I have 3 to 6 months expenses, but I have a pretty secure job. Like take me, for example, like I have a pretty secure job, pretty secure income. My wife's income is really, really good. I don't need to be liquid heavy like 6 months. I have money liquid for other things like real estate, but as far as like quote emergency funds, I invest my entire emergency fund. Like I consider liquid cash that I can get back in like 5 to 10 business days. And I also don't keep any money in my checking account either. I keep all of that inside my brokerage in my buying power. Inside Vanguard, I think it's their money market fund, their federal money market fund. That's where all my cash sits. It's hard to get to. I can't be hacked. You can't be stood up at an ATM. Like inside my checking account, virtually nothing. And inside my Capital One, all my sinking funds and stuff, that's money that I might need or just money that I have coming up. Now, to get past all of that, because you did ask like what type of funds, I got to be honest, and I've said it once, and it's going to sound so cliche, and the people that have been watching my channel for a little bit, broad-based index funds. I don't care if you choose the total stock market or the S&P 500. I really don't care. I do not care if it's in Fidelity. I don't care if it's in Vanguard. I don't care if it's SPY. Like I said, I'm not going to pick and choose like which ones, but you know, VTI and VOO are my go-to ETFs. That's where my emergency funds are, and that's where I deploy most of my money. 96% of my income is there. So I guess like the overall like overarching idea here is don't just invest money because you're afraid you have too much cash. I wouldn't worry too much about that, okay? If you've already convinced yourself that you do, or you know that you have too much cash, and you want to just start to deploy that into the markets, start broad-based index funds. Start VTI, start VTSAX, same thing. Start VOO, right? What's the worst that can happen, right? You change your mind. You know, just because you buy 10 shares of VOO today doesn't mean you have to own those shares forever. Maybe at 25 years old, you're like, you want to know what? I hate broad-based index funds, and I want to be a YOLO day trader. Well, you sell those stocks off and you trade with the money. So nothing's set in stone. Right? Don't get yourself in a mentality where you feel like every single decision you make is going to be the last decision you have to make, because you're probably going to make mistakes along the way. Hell, at 22 years old, you can still screw up like thousands of times, right? At 35 years old, I had $189,000 worth of debt and a negative net worth of like minus $29,000. And I had a house, I had a teaching job, my wife had a job, I had a multi-million-dollar brewery, I had a brand new truck, and I was worth nothing at 35. And at 39 now, some would consider me, with my real estate, a millionaire. So I think you can get there, and I think by asking the questions, you're already doing a good job, bud. I hope that helped answer your question. If it didn't and you want to follow up, just let me know. Leave in the comments, something like that, and I'll be sure to follow up on it. Robin, what are the chances Brad does not say VTSAX or VTI? Slim to none, Robin. You've been around for a little bit now. Slim to none. I mean, it doesn't suck. It doesn't, like, VTI does not suck. Especially in this situation where we're talking, I totally forgot my train of thought. Especially in a situation where we're talking about just like emergency fund money, or not like traditional investments, but like, yeah. Were you guys able to hear his audio when I played the voicemail? I know, like, first time we tried that, it was a little suspect, a little sketch. I tried to fix that, so just let me know. That's right, Dr. Horton. If anything, I'm consistent. The next voicemail is about options. So for those of you that are here for the options, it's actually a really good question. And thanks, C-Knight. Thank you. I appreciate that. And a question that's really never been asked to me before. Like, when I got the voicemail, I kind of like needed to. Oh, thank you for subscribing. Thank you. You may now comment in 1 minute. I had to think about it, because I kind of knew the answer, but I didn't know the math behind it. So essentially what I did was, it's a question about, I'm just going to preface it real quick. It's a question about out of the money leaps options, as opposed to like deep in the money. We're going to talk out of the money, and you just want to know the pros and the cons and how that would relate to the poor man's covered call. I do have an investment portfolio through TD Ameritrade. I trade stocks. Weekly, but want a long-term portfolio set up as well. Yeah, and I mean, I know you mentioned you had Webull set up. Like, nothing wrong with that. You can purchase, like I said, when I say VTSAX, that's the mutual fund if you're inside Vanguard. If you're anywhere besides Vanguard, you're going to go VTI. That's the exchange-traded fund of VTSAX. And a funny thing, a couple like cool things I just heard today. Actually, I heard this one like a couple days ago, that on Fidelity, the minimum for VTSAX has been lowered to $2,500, not $3,000. And then let's give it up for the chef doing weeklies now. The chef is no longer a monthly option. We can now trade weeklies with Tattoo Chef. Let's go. Super pumped on that. All right, what else we got? I currently have more than a year's worth of emergency fund in my savings. It was worth dropping it in. Is it worth dropping it into an index fund now or wait till the big crash? I don't believe in the big crash. JJ and I talked on our podcast last night. There's no indications for me, but like everyone wants to use the high PE, right? There's no indications for me that there's going to be a crash. There's just not. But it could come. But I'm not a timing the market kind of guy, right? I mean, I'm really not. If you time the market, there's been numerous studies. You can't time the market. If you think, but then again, a year worth of expenses, like that's what I recommend if you're gonna like retire or take a gap year or take I recommend before quote retiring or resigning from your W-2 that you have a year's worth. Like I said, I'm not opposed to cash. I'm 100,000 liquid cash, but that's mostly for real estate. I want to be able to make a real estate offer like that without having to, go into my brokerage and make those moves, Nice, David. All right, let's get into this next voicemail, and it comes from a Brad Lee. And then I'm going to share my screen because I screenshotted a couple things. My new monitor got here like a half hour ago. I'm so pissed because I wanted to plug it in. I tested it. It should be pretty clean. You should be able to see. It might be a little small. I apologize for those of you that are going to be watching this on your phone. But I'm going to save this out. You can watch on your desktop or you can Zoom or, like I said, this is still a learning process for me. But first, let's listen to the voicemail, and then we will dive into the digital whiteboard, and we'll talk about the math. Like I said, a voicemail and a question that I've never gotten before. So I hope this is gonna be one of those where like I'm kind of interested on your guys' maybe explanations or opinions, because you might see something that I didn't really look into in the last couple hours.
Hey Brad, it's Bradley. I wanted to know your thoughts on buying an out-of-the-money leap on a growth stock and then wait till it gets in the money before selling calls against it. I would consider this an aggressive poor man's covered call. And my understanding is that first month or two before the leap becomes in the money, that value of the call will be increased a lot more than if you were to do the covered calls in that same period. And then once it's in the money, you can sell calls to not leave money on the table. I understand it has more risk to it than just buying it in the money call and selling calls against it. But I wanted to know your thoughts on this. Thanks.
Okay, so a couple things just right off the bat. Number one, he made an assumption that it's going to be in the money within a month. Major assumption. What's up, Aaron? Thanks for coming in, bud. The other thing that I want to mention is the call, the covered call, the short leg of a poor man's covered call. The value of the premium, it does not matter what the leaps it was, right? Like you don't get more premium on your short call just because it's a leaps or just because it's an out of the money or in the money leaps. So I'm going to take the whole short call out of it and really just evaluate the two the two leaps options, one being in the money and one being out of the money. And like I said, I could really use your help in the chat. If I miss something in here, or definitely get down in the comments if this makes it to the main channel, because I personally, just understanding intrinsic and extrinsic value, I really see no reason whatsoever to buy a leaps out of the money. I totally understand short-term out of the money call options. I understand their risk, but I also understand they have an amazing possibility to make you a lot of money. I tend to work more on a probability standpoint, but they definitely have the possibility to make you a poop ton of money. Let me choose. I think I'll go red. Let me just share my desktop. And like I said, this is going to be on my digital whiteboard. And I apologize once again for those of you that are watching on a phone. I'm going to speak everything out, so you don't really need the visual, but it might help. So let's jump over here. Okay, so essentially what we're going to be looking at right here is this is two HPQ calls. One of them is in the money, and it's considered what I would say deep in the money. It has a delta of 0.85. Okay, so right here, that's going to be the delta 0.85. That's what I consider, pretty deep in the money. It's not that far from the share price, and we can say I use this one because I actually have a call on it. So I wanted to use like this particular example, and I know that HPQ is kind of like a value play, not much volatility. I also did this same example with VUSI, so we'll look at those numbers as well. What we see here, and here's kind of like the math behind what I want us to see. If we look, this thing had a premium of $8.45, right? And we know that's broken into extrinsic value and intrinsic value. And if you don't know what intrinsic and extrinsic value are, I have videos on it. I can go more in depth, ask a question in the chat. But in simple terms, it's actually the video I just released on the main channel talked about these two. The difference is when you are in the money, you have intrinsic value. When you're out of the money, you have no intrinsic value. And all it is the difference between the share price, $29.60, minus the strike price, $22. So this is $760, $7.60 of intrinsic value. So what that means is when everything is all said and done, $8.45 minus $7.60 is going to be what? This is 6 and 5 is going to be 7, 8, 9, 10, 11, 12, 13, 14, 85. So when you buy this in the money, really the money that you're putting up is $85, in my opinion. Like, granted, yes, I have to write the bill for the entire $845, but $760 of that is just me laying out money for intrinsic value, like pretty much the profit that I've already assumed. Now, some things that I want to look at as well. The break-even price for this, okay? The break-even is $30.45. So it needs to go up less than $1 before 2023 for me to break even, okay? That is a 2% gain. So for me to pretty much eliminate all risk, right, I need HPQ to go up 2.8% before January 20, 2023. And during that time, I'm going to sell calls, and essentially my selling calls against it, I'm going to be trying to recuperate $85 in extrinsic value, extrinsic. As we approach extrinsic value, as we approach expiration, extrinsic value goes to 0 because of theta. So I know over time this is going to go down, and hopefully one day this is going to go up. Okay? Because as the share price goes up, the difference between the share and the strike goes up. Therefore, the value of the option must go up by that much. Okay? Conversely, if I go the same amount up, if I go above the share price, if I go up 3 different options, I came down 3 above the share price. This way I'm going up 3. This has a price of $115, much less than $840. Yes, much, much less. But there's no intrinsic value I need to pay for. It's all extrinsic. So essentially the difference between these two options is 115 minus 85. Okay? So what is that, $30? That's really, you're saving yourself $30. Not only are you saving yourself only $30, let's look at some other things here. The break even is $41.15. That is a 39% increase. Now, I don't know many stocks that I would guarantee or at least be very, very confident that this thing is going to go up 39% before January 2023. I can almost say with 100% certainty that it's going to go up 2.87%. And if it doesn't, I still have so much leeway down to my strike price that I can sell to mitigate loss. I can't mitigate any loss here if I buy out of the money. And as far as like he mentioned in that first month, as the option goes up, the out of the money will make money faster. That's not really true either. Let me just erase some of this. Am I breaking up, James? I'm sorry. Is anybody else? Am I breaking up? Thank you, C9. So let's take a look at like what happens with growth. Okay. I'm way down here at $22. The current share price is $29, and this one is way up here at $40, right? As this share price goes up, the value of this option is going to go up because of intrinsic value. This could go down. If implied volatility goes down or theta, as this share price can get up to $38. And the value, this 115, could still go down to like $80. Because when you buy out of the money, you are at the hands of extrinsic value, time, implied volatility, and time decay, theta, and the two of them working together. And as time goes on and we approach this expiration, extrinsic value can only go down. So immediately when this thing goes up from 29 to 39, this option makes $1,000 more. No, $100 more. I'm sorry. 1,000. It goes up. If it goes up, so you get what? I'm like confusing my numbers. For every dollar it goes up, you get $100. So if it goes up $10, you get $1,000 in premium. So now look at that incredible run. This thing just made a run from 29 to 39. Your out of the money leaps is most likely going to have lost money, but this is going to have climbed. And the extrinsic value will probably most likely go down. Right? When we get to expiration, an option only has intrinsic value if it's in the money. That's it. Right? It only has intrinsic value. That's our goal when we sell to close. So I don't know, like holding this long term, you're going to be hurting yourself with data. You'll hurt yourself with implied volatility. You got to go up 39%. I don't know. Do you think he was confused about the difference between in the money, out of the money? No, he knew. He knew. If anything, I think maybe he didn't have like a great knowledge of like intrinsic and extrinsic value, which I don't expect like most people to know. But like I said, but when you know things like that, this becomes very, very clear. Like we have to understand when you pay $745 for this, right? What did we say? Like 700 and what of it was intrinsic value? Like I think it was $720. That's like just a deposit. You get, as long as it goes up, you get that money. Now if it goes down, right, options can go down. You know, that can happen, right? But not only are you're fighting theta and you're fighting vega and you're fighting these three things when you're out of the money. It has to go up 40% to break even. I don't know, to save $30 difference in extrinsic value. To me, the clearer picture is just to go in the money. It really is. I can't see a reason why on a leaps, a long-term anticipation security, why you would want to go out of the money. I understand it short-term. I don't understand it long-term. And like I said, maybe you're thinking to yourself, this is a super conservative stock, you know, but like, let's take, for example, my favorite thing in the whole wide world, Vuzi right now. I actually haven't done the numbers, so I don't really know. This is the out of the money one right here. So this out of the money option, it's currently trading at $12.72 when I screenshotted this. So we're thinking you're going to pay $313 of extrinsic value. You're not going to get any intrinsic value. You're not going to have to put it up either as the deposit. You need Vuzi to go up 81.84% by 2023. The break even is 23.13. Now, once again, guys, I show you these examples because I show you things I'm doing. You see this +2 here. This is a call option I currently have. I'm not just picking stocks to like fluff numbers. I'm showing you like this is the things that I have. Right now, this one has a leverage of 0.92. This is essentially 92 shares of Vuzi. Okay. And the current share price is $12.72. So 840. Let's see, 2, 3. This makes 11. So $332 of that is intrinsic value. No, oh wow, I screwed up. I'm sorry. This should be the share price. Let me go back. You guys are going to see the magic of editing. So if the current share price is $12.72 and the strike price is $5, that means 2, 7, this goes away, up to 12 is 7. So that means 772 of 840. This is going to be our intrinsic value, right? This is the deposit that I'd pay of this 840. So 840, I'd have to do this. This would become a 3. So 3 and 7 is 6, and this would be 8. So you pay, there's $68 of extrinsic value here. That's going to be eaten away. And all I need this to do is go up 5% to 1340. And I can make back $68 of extrinsic value on the poor man's covered call. The main point that I really, really want to make, okay, and Bradley, this is really what I want to say. You considered it, you mentioned that it was risky. You are right. But oftentimes when we put up risk, we want a greater possibility of return. I don't see that in this particular strategy of a long-term leaps option and the poor man's covered call. Like I said, it's not like when you go to write your short call, the brokerage is like, ooh, he's writing this short call with a former out-of-the-money leaps option. We need to give him more premium. The premiums are the same on the calls, so it doesn't matter. And you're making the stock have to work harder to break even on your buy. I hope that makes sense to me, and that's the only way I can really think of it. You know, and by going through these numbers also too, you really see the huge amount of risk in buying out of the money options to begin with. Like, are they a lot less expensive? Yeah. Is $313 way different than $840? Yes. But if I go back to this, remember that of this $840, you are really paying a $772 deposit. As long as that thing goes up, you're going to get that money back. Right? And every time that share price goes up $1, you get $100 more in guaranteed premium. As the share price goes up, intrinsic value must go up. Now, the share price can go up and the value of the option can go down because of that extrinsic value. That's what Ivy crushes, right? The share price keeps going up and up and up, but implied volatility goes down and down and down as we approach theta. So that extrinsic value shrinks. And you're like, holy shit, my intrinsic value is going up. Why is the overall value of that option going down? It's because of the extrinsic value. That's really the way I see it. And I hope that answers your question. And I'd love to continue that conversation. If I did miss anything, I don't think I did. And the numbers really kind of worked out for me. But I hope that answered your question. Robin, I never had to use the overhead projectors. I was in school for them, but I never had to use those ones. I actually took one from my school. I brought it back. At the brewery, I have a huge mural on the wall at the brewery, and we literally did the overhead projector on the wall and traced it out with chalk, and then we painted it in that way. Thank you, C-Night. Like I said, I've never been, and maybe I've never been asked that because I don't know. I've never been asked why it's not a good idea to do out of the money. I've never been asked that. But I hope that makes sense. And I hope that for the people that don't understand intrinsic and extrinsic value, like I hope like that's a good thing to understand. Because so many people don't want to buy deep in the money leaps options because they're, quote, so expensive. If you understand that intrinsic value is money that that's the profit essentially of the option already. Right? All right. Do you guys have any other questions? I'm glad I could pop on Thursday, guys. Please, inside the description of this live stream, I think it's the first link. It's a voicemail. With the exception of Sundays when I normally go live, Wednesdays when I go live with JJ Buckner, and Friday when I'm partying my ass off, anytime I get 2 or more of these, I'm going to dive in. And like I said, I hope I can give like a really good, that's a great thing about a voicemail as opposed to in the chat. I got this question early on in the day. I really got to think about it, take some screenshots to really give you guys some added value. If you DM me on Instagram, this is what happened with Jake. He DM'd me this question today. I said, leave that as a voicemail, buddy. Leave that as a voicemail. David, Sober September didn't really. Is it better to just buy in the money call options, period? Yes. All of my poor man's covered calls start as leaps. I don't necessarily go into my leaps options with the intention of doing the poor man's covered call, if that makes sense. Like it's always in the back of my mind, obviously, but I make my leaps according to the stock, what I think it's going to do over time, its implied volatility at the time, what I think the growth potential is, what the expiration is, what the return on that premium is. So I think about all of that first. I never make the orders at the same time, ever. I really don't. And the other reason I don't do that is because we want to buy leaps on red days, but we want to buy covered calls on green days. So if you're buying a leaps on a red day and then buying a cover and then selling a covered call on the same day, the value of that call is going to be lower than if you would have just waited a couple of days till it's green. So James, I've made videos about like how I'll never just buy 100 shares outright, probably ever again. And this is the reason why. Just buying flat out leaps options in the money, done and done, is the reason why. So if you've never seen those videos on my main channel, I just did a leaps one maybe 2 weeks ago or something like that. I think I did just a leaps video 2 weeks ago that talks about why I will never buy 100 shares outright ever again. I have 100 shares of companies, obviously, that have dollar cost averages and stuff, but like just going in and just purchasing stuff for like, for example, the wheel strategy. I got away from the wheel strategy because I found leaps options, and I found out that I can buy 92 shares of Vuzi for 840. At the time, I got this for 400. This my $5 Vuzi call I got for $400. I got 92 shares for $400. It's currently trading for $12. So that's kind of why. Thomas said, if it's for a poor man's covered call, I don't know what that's in relation to. Sober September, David, that was short-lived. Actually, no, because I did have some drinks on the live stream last night, but I did not catch a buzz. So is that still Sober September? I don't know. It was first day of school. I needed a drink last night. Robin said, love this. I love seeing the math. Yeah, the math makes it really, really fun. And also the math can eliminate emotion from things. like kind of like with a real estate deal. Like Rick Jarman always says, if the numbers work, JJ, buy the deal. Well, when you know the numbers, you could take the emotion out, especially if you're disciplined. Like I look at this and I'm like, why would I buy this out of the money call option? Why would I do this? It sounds ridiculous. Will you still do cash secure puts? Love cash secure puts. I wrote one today. You're in the Discord. I posted it. Did I posted that. I sold did I not post that in the Discord today? I sold a Vuzi put $10 today. If I did not put that in the Discord, because I did close some things. I did some moves today. David, get me if I'm wrong, but I'm pretty sure I put that in the Discord today. Yeah, I wrote puts actually in the Fidelity portfolio. I put that in the Fidelity portfolio. I did 2 contracts, and I got at $10. I got $110 worth of premium. So I got 10% for 144 days. So that's like a 28% annual return. So I'll take that all day. You didn't inhale. No, not yet. Not yet. Do you ever just buy a call and not sell calls against it? Yes. Yes, I do. Not for a very long time. Because it's always going to make sense to make the call against it to me. But, I mean, I held an Apple Leaps for almost 3 months and I didn't write a call against it. Because I was afraid of it getting assigned. Because I really wanted the Leaps. It was doing really well. Apple was on a run. I'm like, I am not going to F this up. The same thing happened with Vuzi when Vuzi went on a run. When Vuzi went from like $20 to $30, when was that? That was like maybe February, March-ish. It went on a nice run when it was hitting like $30. It was right around when Aaron Azevedo was on the Average Money podcast. And I didn't sell calls against that Leaps as well because, once again, I was afraid of it getting assigned. Doing Leaps options with stocks that can shoot up is a bad idea. And I mentioned this in the videos. You want steady, consistent growers. So all the things that I have Leaps on that can just shoot, I won't sell calls against them. I'm selling calls against Vuzi right now because Vuzi's in like one of those where we don't know what the hell's going on with Vuzi, and I don't see it popping 10%. But there was a time where Vuzi was popping 10, dropping 20, up 18, and I was just like, I'm not going to sell calls against it. I'm just going to let the Leaps rock, and then we'll figure it out. Thanks, Robin. Yeah. Puts are just all about return on investment. Look at the collateral, divide it by the premium, and then get that initial return on investment. And if that works for you, especially if you push it out annualized, like I said, it was really easy, the math for me. I made a $10 put. I got $110. Boom. I'm like, all right, there's 11%. Then I'm like, okay, where's the expiration? 144 days? Sweet. That's like a third of a year. So I multiply that by 3. I go from 11 to 33% annualized return. If I get assigned at $10, I want Vuzi at $10 all day long. If I don't, it expires worthless, and I got 10% of my money in 144 days. Who wouldn't take 10, 11% on their money in 144 days? Was it 105, 110, something like that? Do you do technical analysis on stocks? I'm learning. The day trading and the technical analysis chat inside the Discord has been helping me. I mentioned last night on the live stream, I just found out I have a 16-year-old student that has a 40,000 person Discord chat with trading alerts and stuff and technical analysis. So I think J.K. and I are going to be good buddies this year in school. And we have class third period, 9:30, right when the market opens. So I'm not sure how much physics is going to be going on in there. But I'm learning that. It's something that I feel comfortable with everything else. I try not to be learning too many things at once because with ADD, I just get super distracted. So, I'm learning it. Not as much as I like to. Let's all make that dough. Hell yeah. You didn't keep having to roll it up, did you? Roll what? The what did I miss? Sorry, when we're talking, and I think there's only like a 2 or 3 second delay in the chat, but sometimes I don't know what's in context too. Why not buy SPY Leaps? We've talked about. Okay, hold on. So in a Sunday live stream, and I post this on the main channel. So you can go to the main channel. I think it was only a 4-minute clip I pulled out, and it's like trading options with ETFs. And I spoke specifically about SPY. So I'll just summarize that. I'll give you like the Cliff Notes version of why I don't do SPY. It costs so much money, and the return on investment isn't worth it. It's a broad-based index fund with really, really high expense ratio, subpar returns, and a pretty low volatility. The premiums just aren't that good. Everyone gets so excited about SPY because of the 3-day expirations and things like that. I mean, frankly, I don't know. I would like to do, I probably wouldn't pick SPY. I'd probably pick VTI or VOO, but the volatility just isn't there to make the premium value worth it to me. And also, too, there's a strong part of me, Robert, that is like, these broad-based indexes can't return 30, 40% every single year. Like, it has to go back to its traditional 7 to 8%. It has to. I don't know when, but I don't need to care about when, because I can mess around with some of these more speculative stocks and these things that have a higher potential to pop and do that growth over time. I could get burned. I don't know. I just personally don't trade options, or I don't buy options on indexes. I just don't. I trade the wheel at VTI because it's like it's there. I have hundreds of shares of it, but you kept having to roll it up, didn't you? Oh, at Vuzi? Yeah, when Vuzi popped, and like I was writing calls at like 0.15 deltas, and it just kept going. And they were monthlies too, so like it would go, and I'd be like, shit. And then I'd watch it, and I'd watch it, and I'd watch it. It would come back down a little bit. But when Vuzi was hot, it was hot. It's kind of like what the chef is doing right now. The chef is going to pop. I mean, and when I say pop, I don't mean like $50, like short squeeze pop. But right now, September 17th, I think my 2250 calls are just in a lot of trouble. I mean, we can kind of look and see. I'll bring up the portfolio quick. Hold on a second. I want to say that my short calls on my short calls on the chef right now are it's bad. It's bad. Like thousands. I think it was like 1,000% in the loss column today. Where we at, chef? Where we at? Let's take a look here at desktop. So the chef right now, yes, the chef, I am down 1,020% on this call. So the chef went to, it's what, 23 today? 2402. Yikes. I never wanted this thing to go down. Now, let's check out the leaps. So here's like the situation I'm in. The leaps is at, and I'm sorry for the people that are small here on the thing, but the leaps is $270. I'm in the green, but the short call is at $255. So at a $255 loss, this maybe is like what's coming up for me. There's a pretty good chance that I might just close both of them at the same time, take the $25 and run with it, because of how long I've had this call, had this leaps, and what my percentage gain is on it. Like as far as how many calls I've wrote against it so far. I don't know. I would like this to come down and let theta hurt this. I would probably I'd pay $200 to close it and protect the leaps. I'd pay $200, I think. That's pretty safe to assume. Let's see what the chat says. HPQ looks like it could coverage around 10 to 1. May want a second opinion. I'm just learning technicals. Yeah, I'm just learning them too, bud. But my HPQ, like I've had that thing for like a week. And that's already up 14%. That's had a good run. And then I sold a call on it today. I think those were the moves I made today, right? Here's that put. Where's that put? Where you at, put? Where you at? Where you at, put? Here it is. So this is the Vuzi put that I made today. $10. I got 100. So yeah, boom, I knocked out 10% right away. 144 days out. So, but the value kept going up. I could have got $118 for it. Whatever. Why is it so blurry when you share your screen? Probably because this is a POS monitor. And but I just got a new one. So on Sunday's live stream, it should be crispy nice. Crispy nice. I apologize for that. Brad, I'm selling my house and I'm going to pocket $150K after splitting it with my nutty soon-to-be ex. Sorry about that, bud. How would you spread it out? I would ask, have you lived there for 2 years? Because if so, that's free monies. If you haven't lived there for 2 years, you got to pay taxes on that. So let's spread some of it out to the IRS. I assume you at least got to live in the house before it all went to shit for more than 2 years. $150K? Well, let's go through like the realistic checklist. If the so you're getting that tax free. Okay, so one, consumer debt. That's going to be my first go-to. My next would be you need somewhere else to live most likely. So whether you want to buy, that's a down payment somewhere else, or whether you're just going to do the condo or van life, that's dope. You can do that with the $150K. You can lend it out as hard money and get 12% on your money. I'm sure there's a lot of flippers out there that would love to have $150K on 10 points. But if it's good old Brad, like if somebody dropped $150K in my lap tomorrow, I would hold it in cash for a little bit. That would just increase the amount of I want to own real estate. So if somebody dropped $150K in my pocket, all that means to me is I can now do bigger deals. I can go, instead of duplexes, I can look at fourplexes. So I'd probably hold it in cash, only because I'm very happy with my investment portfolio right now. Depending on age, if I'm playing catch up, this, that, and the other thing, I might put some in. But like, you really can't screw it up. Just don't YOLO it. You know, make it make you money. You know, nothing better than like bumping into your nutty soon-to-be ex-wife in like 15 years, and that $150K became $15 million. you know, like, hey, already bought a house. Sweet, so you're good. I mean, you could pay off the mortgage and retire. I don't know. How old are you, bud? How old are you? Would you recommend splitting a portfolio 50-50 VTI and VOO? Jake, I am going to say this. I consider them, and I think there's a lot of people in the chat that would agree with me. I consider those identical investments. The IRS doesn't. They aren't. One is the total stock market. One is the S&P 500. The total stock market VTI outperforms it. Do I own both? Yes. And I own them in different portfolios. Brad, why would you buy VTI in one portfolio and VOO in another portfolio? Mostly because of the age of those accounts. And I tax loss harvest when I take big gains. And because the IRS doesn't consider them the same, if you don't know tax loss harvesting, and that's a horse of a completely different color, and it's a long conversation. So don't even worry about that. But if you said to me, Brad, I'm going to put 50% of my money into VOO and 50% of it into VTI, I'm going to say, great. I'm for that. But I'm just going to give the caveat that essentially you are making the same exact investment. It's about same exact as you can get. It's like one step up on the new iPhone. Like it's the same phone. Like one's maybe slightly better. I think VOO has a 0.03 expense ratio as opposed to 0.04. So we're talking $1 on every $10,000 invested. If that's a big deal to you, then maybe you go VOO. But I would consider them pretty much the same. why not roll your short Tattoo Chef call into October expiration? Is it because you've held it long enough that you don't mind losing the leaps? Yes, I don't mind losing that leaps, but you're absolutely right. That the rolling option I will definitely look at. I have 16 days, 15 days, right? It's not this Friday's expiration. It's not next Friday's it's like I have almost 3 weeks, 2.5 weeks. So to be honest, if it runs any higher than this before, like say it's the 12th, Monday the 12th, and Tattoo Chef is trading for $25, $26, and the value of the option, I'm still down. I said it's more of like what I'm willing to pay. I'm willing to roll it for like $200 loss. Any more than that, I'll probably just close it out. I already own a ton of shares of Tattoo Chef in other places and like the main brokerage and stuff. So my exposure to Tattoo Chef, I could even consider like a little over leveraged, but not over leveraged in the part where like I have margin out on it, but over leveraged in the fact that like I might hold too large of a position in Tattoo Chef anyway, as far as my individual stocks are concerned. But that's why. It's mostly because I've had it for a pretty long time. I'm 43, could retire anytime. Sounds like good times, any bud. Take that 150 grand. 150 grand, the 4% rule. It's going to be nice. I'd say invest it in. Put in something simple where you could use it for a real estate investment. Or like I said, get on bigger pockets and start talking to people. You could find people that will take that money and you can make some money off of it. I know a couple people, but you're in a good position. I'm sorry that things didn't work out with your wife. That obviously sucks. We could joke about that or not, but that does suck, but it seems like you got a little bit out of it. That doesn't really suck that much. Robin, that's great. Every time people bring up exes, Robin is right there. Sorry, guys. I'm just reading the chat. Just keep dumping in VOO then, bud. Dude, VOO is 500 companies. You're diversified. It's safe. It's going to track an index. It's set it and forget it. You're 22, man. Like, just keep on VOO. At this point, you can do whatever you want, man. $1,000 on 100 shares. That's fine. 100 shares. 1,000 shares would be, that'd be nice. What's VTI trading for? 420 or something like that? 425? Not too bad. That would be, if you had 1,000 shares of it, that wouldn't be too bad. But yeah, man, just keep going VOO. It's fine. Like, at your age, man, you could probably go like, I know JJ Buckner would differ from me, but like, I'm more of like an 80% index funds, 20% individual stocks or options or whatever at that age. JJ would be like 50-50, man. He'd be like 50 index funds, 50 stocks, growth stocks, dividend stocks, whatever you want. But it depends on your education too. Like if you're still learning, put it in VOO while you're learning. And then as you learn, you can deploy it other places and sell off some VOO. No one's going to call you a donkey for that. How old were you when you started investing? Literally 35. Because we started, I've had a Robinhood account since 2006. Will this tell me what I want to go? I can look at my account. Let me see when I opened this account. I think I opened this account in like 2016. But that was to do the wheel because my roommate in college did the wheel. So I was doing the wheel really before I was like investing in stocks. History. It's going to be really hard to go back. But yeah, I would say, I saved money. I was always a good saver that my dad made me be, but like investing in the markets, no, I didn't. I got my first job in 2006, like my first big boy job, and I did the 401k at that job. So I guess that's investing, but that was just like whatever the human resources or whatever the guy that came to the water cooler told me to invest in. But the first brokerage platform I had was Robinhood in 2016. And the reason I didn't have one before, because my very good friend works for Fidelity, and he tried to get me to go there for so long. But I was so cheap and frugal that I never I never wanted to like pay the fees, especially like back then when like fees, even like E-Trade was like $10 a trade. And I'm like, I don't even have like a lot of money. I don't want to invest $100 and have to pay 10. And then when Robinhood came out and it was like, you could do it for free, I was like, all right, let's try it. So yeah, man. I have 33,400 in Dogecoin. What would you do with $1,000 of it? I would get it out. Do I still have Dogecoin? Well, I think I put $50 in a long time ago. What is it trading for? I think I got it at 41 cents. It's 29. I'm down 27% on my equity is $35. I'm getting away from crypto. Just getting too old. I don't want to have to worry about it anymore. Been slowly selling off my Bitcoin. I think I'm down to like maybe $1,500 left in Bitcoin. But I was also like a YouTuber that got all caught up in that first hype, and like I got it pretty cheap. So I've done pretty good with it. So I'll take it. I'm learning like as I get older, like it's okay to take 50% gains. Like I don't need to sit around and wait for 100 anymore. I bailed on my 401k, covered call ETFs instead. There's a lot of people that the 401k is just not worth it. I have a 403b now because I'm a state employee, but I advocate against the 403b to most people because when I look at their stuff, I'm in like a really, really good district and they really, really take care of their employees. So I'm very, very lucky when it comes to that. But I know a ton of people that it's hard. It's hard for them to justify paying the fees or the investment options. A big difference between the 401k and the 403b. As a 403b, I have a whole list of investment opportunities. I can use a whole bunch. Where usually when a 401k, your employer sets up like one company that you can work with, at least from what I've seen. Nice, Thomas. I mean, people win in Bitcoin. I clap. Just like people won in AMC and GameStop. I clapped. That deep effing value guy, I clapped for that, dude. I'm not jealous, but like it didn't make me want to do it. I'm okay clapping when people win. I understand that I can't be those people sometimes. And I'm not sure that I even take enough risk to ever be one of those people. But I'm also very, very good getting to 65 years old and having a couple $1 million invested and like talking to people and being like, oh man, you have $6 million. If you would have done this, that, and this, you could have 12. And I'll be like, 6 is pretty dope. I like $6 million all day. So that's kind of like what I'm seeing at almost 40 years of age is like, it used to be about like, I want a real estate empire. I want the biggest brewery on the East Coast. I want the biggest CrossFit gym. I want a ton of money. I want my net worth to be stupid. And then you just realize that like if you have enough money to live, like right now I'm financially independent and I literally go to my teaching job every day because I like it. And I know that if I ever stop, I can leave. That's really the only amount of money that you need. Everything else on top of that is just like gravy, I guess. So that's how I feel like with the asymmetric bet of crypto and other things and speculative investments. I personally don't need to play that catch-up game anymore. I'm like pretty good financially, so I can just kind of sit at the sidelines and watch people do it as sport and clap for them when they win. I love reading about these crazy stories where, you know, people invested this, that, even with the Dogecoin when it was going, like hearing about it, but how many people actually sold off, you know? It's okay to take profits. People don't want to do that. Greg, what's up, buddy? Gilly, what's up, bud? How's that row? Gilly's killing it, bud. Killing it. Killing it on the rower. Oh, Ricardo, thank you very much for subscribing, bud. You will be able to talk in the chat in 1 minute. You're a TTCF. Doing nice. Yeah, it's pretty good. Do you guys have any other questions for the chat? My dad is a retired college professor, state pension, Social Security covered. Yeah, that's... My pension's going to be small because I'm going to get out of there well before my pension age. But it's the one thing, it's so upsetting. I talk to teachers in their 50s and their 60s. Not too many in their 60s anymore. I talk to a lot of teachers in their late 50s, and I tell them that I'm going to go, and they're like, what about the pension? I'm like, the pension is like $2,500 a month. Like, that's not a lot of money. I'm not going to work till I'm 63 to get $3,000, $4,000 a month. I'm just not going to, like, the pension, guys, your pension, just like Social Security, when you get to that age and you get your first pension check or your first Social Security check, that money should be like, what is this? What? Oh, I forgot about that. What am I going to use this Social Security check for? Like, that's my goal for it anyway. You know? I don't know. We have so much time to, like, to invest and make money. Like, take, for example, the calls today and the questions that he's asking. He's 22 years old, Jake. He's 22 years old. He doesn't even need to save that much money. Like, if he went into a compound interest calculator and, like, did the math, I think it would blow his mind. It blows mine. 11 out of 10 live stream. Thank you so much. No, thank you, but I appreciate the voicemails. It makes coming up with content, and I would love to live stream every single day. I would love it, with the exception of Sundays and Wednesdays and Fridays. But I appreciate it. Thank you so much. Through my 457, yes, I love when I hear people say that. I'm allowed to take a loan up to half of the value paying myself for it. And I say, I'm not against loans against retirements, but hold on. Let me just read this, though. Loan up to half of my value, paying myself 4% back plus $75 fee per year up to 6 years. What are your thoughts on doing this to pay off high interest debt? Okay. That's a different story. But, Ryan, I'm for eliminating high interest debt. I consider high over, let's call it 18%. I would say 20, but that's too cliche and round. Anything under that I think is manageable, but it also depends on how much it is. Like, I'm not going to borrow $1,000 to pay off I'm not going to borrow against my 401k to pay off $5,000, $10,000 of a credit card. I'm just going to bust that out. I'm going to make it happen. I have the income to do so, where that's, like, manageable for me. If $5,000, $10,000, you can make that whatever number you want. But I will say this. I think there's other ways to get that money to pay off your higher interest debt as opposed to borrowing against your retirement. Your retirement is your foundation. You know, like, even M1 Finance gives you 2%. You know, granted, it's only 3.5% of your portfolio, so you do need to accumulate a good amount of money in there. But unless we're talking like tens and unless we're talking like 25K of high interest debt, I'm just going to say just attack it. I'm going to attack it. I just kind of like how I don't F with the mouse. I don't F with retirement funds. That's just my opinion. I don't know. But I've never been in the position to do so. Like, I've never been in that position. So I can only speak from, like, Ryan, I can only speak from, like, a technical analysis point of view. There's no emotion for me, right? And that's, like, taking emotion out of it. I'm saying, no, don't borrow against your 401k. End of the story. Pensions used to be a lot better than they are now. Yeah, they are. And I'm pretty sure, like, correct me if I'm wrong, I'm pretty sure, like, 401ks and stuff were built to pad pensions going down. But my father-in-law needed to retire because he could make more money with his pension than he could working. That's a good pension. I think same thing happened to my father. He worked on the railroads, and, like, they got like a disability early because, like, working on the trains his whole life, they all have back problems and knee problems from the shaking of the trains. He was a conductor, collected tickets. So I think between his pension and his disability, I think he collected a bunch of money. Brett K, what's up? Brett, Sundays are my guaranteed nights, but every time I get voicemails, I'm going to come live if I can. So if anybody has a question, please leave voicemails. The link is in the description. It's right on the top. Just leave a voicemail, just like JJ and I do for the Average Money Podcast. Leave me a question, any question you got. And once I collect a couple of them, we did 2 tonight. This will also stay public, but I'm going to clip out those two and maybe some other things from this, and I'm going to get them onto the main channel as well. Main channel for personal finance YouTubers, I'm sure you guys have heard it from everybody. It's been a tough go. So this live channel is kind of me trying to diversify my YouTube content a little bit. So hell yeah for railroaders. 35% of portfolio value on M1 Finance. Yeah, at 2%. Could change the variable rate, but right now it's 2%. My plan is to, Dom says that my plan is to have enough invested that I don't need Social Security. Amen, brother. That's exactly what I want. Jake, you already set up, buddy. Don't screw it up. You're good. You can screw it up. Like I said, if you get to 35 years old and you have $188,000 worth of debt at 35 years old, you're doing better than I was doing. All right, guys, 9:15 here on the East Coast. I'm going to have to get out of here. Let me see, actually. My phone's upstairs. Can anybody tell me the Mets score? I can look it up. If the Mets are close, I got to go. Let's see what we got here. 3-3, guys. 3-3 in the 7th, guys. I'm going to go try and catch the rest of this Met game. Please, leave me voicemails if you have them, right? Don't be shy. You know, if you want an anonymous, you can put anonymous. Like, if you have a question, please. Because it makes it so much easier when, like I said, as I mentioned before, when I can get screenshots and bring in examples from my own portfolio, have them here, digital whiteboard. It makes things great. All right. You don't have Alexa. It's upstairs. I'm down in the basement. I do have Alexa. It's up there. All right. Have another beer and hang out. Not tonight. Not on school night. Tomorrow's Friday. I'll be ready to go tomorrow. All right, guys. I really do. I appreciate your time. Thank you so much. And I'll catch you on the next one, guys. Oh, wait. Let me do my outro. Till I catch you guys on the next one. Stay positive. Work really hard, and I beg you. I really do. Go out there, try and be kind to other people. It would be a very nice thing to do. Take it easy, guys.